a chartered wealth manager and a chartered accountant herself. So it's a pleasure to welcome Rakhi Jain, who is an expert in all topics of finance, having created an entire career of about 20 plus years in the world of finance. And Rakhi has held senior leadership positions at Unilever and other corporates, and now has embarked on her own journey as a wealth advisor. So, what better mentor and friend to have to support us in this topic, and somebody who makes the world of finance more accessible, more easy to understand, and simplifies it and simplifies all those fancy terms for all of us. So, thank you so much, Rakhi, for this workshop. And over to you, and we're looking forward to an engaging session.
Thank you so much, Manali, for your introduction. Thank you. Hi, everyone. I know it's a busy Thursday, as always, but all of you have taken time out to spend some time on this topic. It really shows the interest all of you have. And thanks for giving this opportunity to Manali and Rima. And yeah, I'll spend the next about 45 minutes with content and keep the last 15-20 minutes for Q&A and interactions and so on. It's going to be an interactive session, so please use the chat window. As and when I ask questions, please put your answers on the chat. It will just show me that you guys are listening, and we can keep it more interactive. Feel free to also answer the questions by just speaking out. That's also fine. Any questions that you have, please hold on to it, and we will take it in the end so that we complete the whole flow of the session. It's a very, very vast topic. It's difficult to cover a lot in 40-45 minutes, but I've tried my best. Also, like Manali said, there was a mix of, I did a survey before this and about 22 people responded. So thanks to everyone who responded. What I've seen is it's a mix of crowd. Some of you are just beginning, whereas some of you are in advanced stages of investing your own wealth. So I've tried to keep the content in a way that even though it's simple, so and easy to understand and very practical, so even a beginner can take a lot out of it. At the same time, even for the advanced investors, there is something for advanced investors as well. Hopefully more than just a refresher. So with that, let me start off. I think Manali, thanks for already introducing myself. I will just talk about, what made me take this career switch. So after 23 years in Unilever, I've actually changed my career. I just left Unilever about 12 days back. I'm actually switching paths from corporate finance to wealth management. And the reason I'm doing this is twofold. One is, of course, I enjoy doing it. I enjoy investments. I enjoy, analyzing investments, tracking investments, seeing how the markets are performing, just the whole behavioral aspect of it, the analytical aspect of it. So I really enjoy that. I've been doing it for my own wealth, my family's wealth for many years now. So that was really the trigger to start off. At the same time, I saw that a lot of my colleagues, finance and non-finance colleagues, are not very good at it. They've not been able to really create the wealth to the potential that they could. Also, there is a lot of mis-selling that happens in the industry and so on. So I thought there's an opportunity for a lot of people to benefit from, balanced advice, the right advice. And that's the reason I'm getting into this industry, and really excited for what is next. As far as this session is concerned, please treat it as education only. It is not an investment advice. The purpose of this session is basically to educate, and especially I think for women, this is really important to, because a lot of you have delegated your investment decisions. Even when you delegate your investment decisions, whether to your family members or to financial advisors, it is still important to have that knowledge. And this session is really to make sure that, everyone is on at least some base knowledge. Cool. So with that, let's just deep dive into it. We will cover what is wealth, why should we invest? If we invest, where should we invest? So what are the asset classes, asset allocation? We will also cover where not to invest. We will talk a bit about compounding and the power of compounding and how you can make that work for you. Then a little bit on estate planning, and finally end with a quick summary. So I think quite a lot of topics which I've tried to cover. So let's see how it goes. Let me start right away with a quick question. So I think for everybody, wealth or money will mean something different, right? So if you can just tell me, what does wealth mean according to you? Put it in the chat box, or, just maybe unmute and see what does wealth mean to you. Manali, I'm going to, I think, have to stop presenting to see the chat box. Anyone wants to take a shot?
Hey, Rocky, Priya here. I can't find the
Hi.
chat. Sorry. Yeah, I
Oh,
don't know
it's
if you can hear me. Yeah, for
yeah,
me, it's about, I think, independence and confidence.
yeah. Independence, confidence. I can see freedom. Anyone else? The chat box is at the bottom, right. Oh, yeah, freedom 2x for sure. Sustained source of money in the long term, absolutely. Vipin. Okay, I'll wait for one more response.
Hi, Mohana here. Um, Apart from all that everyone has said, I think, just that zing of doing something on your own, which is a very male dominated area, is something which I would love to do because I've seen investments and all these things done mostly by the male, the men around. Does that make
Okay.
any sense?
Yeah. Okay. So basically, the ability to manage your own money.
Yeah, yes.
Got it. Listen, all of these are valid points. Okay, you saw my answer already. So, the textbook definition of wealth is basically your ability to maintain and grow your purchasing power, which is what someone mentioned, that how do you make sure that you have sustained wealth throughout your life, and life can be really long, and even life after retirement can be really long. So how do you make sure that you're able to maintain this money and also grow it? And it's not absolute money, but it is rather your purchasing power, your ability to keep purchasing and or keep spending needs to be either maintained or keep growing. And when you have wealth, it does give you a lot of freedom. It gives you a freedom to choose how you spend your time, where you spend your time, what kind of passions you're able to follow. Because let's face it, everything needs money, right? So when you have this heightened purchasing power, you do get this freedom as well. So yeah, absolutely. Many people said that wealth is freedom. Wealth does give you freedom, but it is really your ability to keep maintaining and growing your purchasing power. And what do I mean when I say purchasing power? Purchasing power is basically the wealth that you create over and above inflation, because purchasing power of every currency keeps declining consistently. Some currencies decline a lot more, like INR, but even a strong currency like dirham and dollars do decline as well. So if you look at last 25 years, a lot of your expenses have gone 3 times, 5 times um, in 25 years. That's an inflation of almost 3.5%, 4%. For a strong currency, that's fairly high inflation. So in 2000, with 100,000 dirham, maybe we could cover 4 years of school fees, but now it's like hardly enough for 1 year of school fees. And this is inflation when we compare apples to apples. But what happens over generations is lifestyle upgrades also happen, which push up these inflations dramatically. So if we look at how we lived in our childhood and how our children live, it's very different, right? The houses are getting bigger, the schools are getting more international versus local curriculum. The phones are getting more modern. Our holidays are getting upgraded. The way we live gets upgraded. So inflation also increases dramatically. Therefore, for us to maintain and upgrade our lifestyle, that is, to beat inflation, we actually don't have much choice but to invest, because that is how we will be able to keep growing our purchasing power. Okay. There are many levers to grow purchasing power, and this is where again I'm going to ask one more question. There are three main levers to grow purchasing power. Any guesses on what these could be? So if you keep growing your wealth, look at purchasing power as wealth. What are the different ways in which we can keep growing our wealth?
increase your income and increase your savings?
Absolutely, absolutely bang on. So yeah, the first is to increase your active income. This is the first thing. Like all of us start our career, start earning through our active income. We do something to earn money. It could be a job, it could be a business, it could be a profession like a doctor, lawyer, CA, whatever it is. It is something that we are doing to earn income from our time or the services that we provide. So that is our active income. So that's the first lever, and most of the time it's the biggest lever. Second is also important to, like Priya said, increase your savings. How do you increase your savings? Income minus expenses is your savings. So managing the expenses and risks is also important. Like, our elders used to say, "Jitni chadar hai, utna pav phailao," right? Don't go overboard, don't dikhave mein mat jao type of thing. So it's about managing your expenses within your active income. The lower your expenses, the higher your savings will be. Not just expenses, but risk as well. And I'll talk a little bit about the kind of risks that we need to manage a little later in the session. And the third one, and the topic for today, is also investing and compounding our savings. So the way we work to increase our active income, we work really hard to, manage our budgets and make sure that we are able to save something. It is also important for our money to work with us, along with us. And that is why it is important to invest your money invest your savings so that it is able to compound and work alongside you to keep growing your wealth. I will just end with this small circle, which is basically a virtuous cycle. Once you start growing your income, active income, you have more income, you manage your expenses, you get more savings. With that, you do more investments, and that creates wealth. And then this becomes a virtuous cycle, because the more wealth you have, the wealth also creates income. If you have properties give you rental income. If you have shares, they give you dividend income. So the wealth itself keeps creating more income, and therefore it becomes a virtuous cycle, which is why they say the rich keep getting richer. Any time when over the years, the rich keep getting richer because they have multiple sources of income working for them. And they are, on this virtuous cycle. So this session is about how do we get on these virtuous cycle where our wealth is creating more and more wealth for us. So like I said, this topic is more about investing and compounding your savings. Because I'm sure all of you know how to increase your active income. To some extent how to manage your expenses. Risks I will talk about later. But investing and compounding is what I'm going to be focusing the rest of the session on. So now the question is, where do we invest? So there are 5 main categories of asset classes, which I'm sure all of you are familiar with. So anyone wants to talk what these asset classes are? Asset classes are basically categories of assets in which we invest.
Real estate?
Absolutely. Real estate is one.
Stocks.
Yes, stocks or equity.
Mutual funds.
Yes. Mutual fund is a vehicle which invests in either in equity and other things. But yes, mutual fund is also, equity is also an asset class, and mutual fund is a vehicle through which we invest in equity.
Does gold count?
Gold, yes. Commodities, gold is an asset class. Gold, silver, commodities, oil. Anything else?
Cash is an asset class, right?
Yeah. Not cash, but basically deposits that you keep with the bank. Yeah. So I think you guys have got it. So equity is an asset class, like you said, stocks, mutual funds, all of these are equity. Or even your own business, the ownership stake that you have in your own business is equity. Equity basically means ownership of an income generating asset, so ownership of a business. Then there is debt are of 2 types: long-term debt, which is all your bank deposits more than 1 year, 2 years. In India, we have this provident fund, pension funds, all those are long-term debts, debt more than 3-4 years. Short-term debt is the amount we keep in the bank. So it's basically a debt because it's a loan that you give to the bank. When you're keeping money with the bank, it's basically a loan that you're giving to the bank, which is why it's called debt. Then, of course, real estate and commodities, which is gold, silver, maybe even oil. So
Rakhi, when you say, sorry, a question. When you say Equity, does that also count like investing in some business and not your own, like just having a stake in some business?
Absolutely.
Yeah.
Absolutely. It does count.
And Rakhi, one more question in terms of the new age cryptos. Is that
I'll come to that.
okay?
I'll come to that. Yeah. These are, see, there are many categories of asset classes beyond this as well, but these are the big ones. These are the main ones in which most of the wealth of the world is invested. So let's say savings account in Dubai. If we open a savings account in Dubai, most of the time we either get 0% or maybe 1.5%. So that's like the average annual return. Maybe a long-term debt like FD or a Sukuk or national bonds, etc., might give you something between 2 to 4%. Dubai real estate is very cyclical, but average 10-year annual return is somewhere between 7 to 10%. Gold. So the first three are more dependent, but now as we go down, it is more certain because it is based on data which is reported. So gold, 24-karat gold, has given about 12% return. S&P 500 has given 30% return. S&P 500 is an index of the top 500 companies in the US. I've taken India equity. I've just taken one mutual fund which has been around for 20 plus years, HDFC FlexiCap Fund, which has given 13.5%. NASDAQ 100, which is another US equity, which is more focused on technology companies, has given about 17%. So the point really is some asset classes, and we saw in the previous chart, inflation, many of our purchasing power. Inflation, reported inflation in Dubai is about 3.5%. But actually on the ground, when you look at lifestyle upgrades, etc., the real inflation that most people would feel will be in the range of 7%. The so-called safe assets that many of us tend towards, which is keeping money in the bank or keeping money with bonds, do not beat inflation in the long run. Actually, investing in these kind of funds is destroying your purchasing power. But the real asset class which actually gives growth in the portfolio is equities, because these are investments in businesses, and businesses exist to make profit. And businesses will always try to maximize shareholder return, and therefore they will grow over and above inflation, especially with innovation in the economy and so on. Guys, keep asking questions. So if you have anything in between, I think it's good to keep it interactive. Now
Hi,
that
Rakhi. Just a quick one. As you covered the previous slide, any light on Gift City funds or Gift
Yes.
City mutual or index fund? Because that I think excludes the currency depreciation and also there's no taxation, I think.
Absolutely.
Yeah.
I'm covering about Gift City. I will
yeah,
cover
sure.
that.
Yeah, thanks.
So I'm no other questions. I'll just talk about, you've understood the asset classes. Each asset class has some characteristics. So it's important to understand how each asset class behaves because they behave very differently. So that is the characteristics. Also, I will cover what kind of return potential they have and also what is the risk they have. And also what should be the role of every asset class in your portfolio, because you need to, always aim to build a balanced portfolio. Every portfolio should have each of these 5 asset classes and in a certain balance. So how do you decide what? And that was one of the questions that came up again and again in the survey as well. How do we decide how much to invest in what to invest in, what not to invest in? So this will really give you a kind of understanding of how does each asset class behave and what is the role of this asset class in your portfolio. So let's take short-term debt, which is basically money you keep in the bank for very low rates of interest. So this is very low risk. Typically, most of the cases banks will not fail. So largely low risk, high liquidity, because you can withdraw the money anytime, but also low returns. Yeah, it does not beat inflation and so on. But it does have a role in the portfolio, which is of ready cash. I mean, you cannot invest every money. You need to keep some ready cash. So this is where, keeping money in the bank comes in. It's only basically for ready cash. Then for some emergency funds, say if you don't have insurance, for example, someone doesn't have insurance for their parents, so you need to keep some medical corpus as something which is ready. So you have some goals which are coming up within 2-3 years, then you don't want to put this in asset classes which are more volatile. So short-term debt is when you need ready cash, you need some emergency funds, you have some big expenses coming up within the next 3 years. That is where you use this asset class. One nuance here, there are also arbitrage funds, which are also quite safe, but which give slightly higher returns, which also you can use for some of these goals. So arbitrage and short-term debt, I kind of put them together. The advantage in arbitrage funds is they give slightly higher returns, but you need to choose the right fund. Coming to long-term debt, this is basically more for India because in India you have PPF, NPS, etc., which pension funds could be an example here. So these are typically which will give you a fixed income, say 4%, 5%, 6% returns in INR terms. In India, in AD it is more like 2 to 4% return, but it gives you a fixed income. I mean, most of the time there is a guarantee. Low volatility, so it does not move up and down. But at the same time, returns are low, liquidity is low. And there is risk as well, yeah. There is a credit risk. So if you give a long-term debt to a party which actually goes bankrupt, then you're not going to get the money back. So there is credit risk. There is also interest rate risk. So sometimes when we invest in long-term bonds and the interest rates go up, then the value of the bonds actually goes down. So there is something called interest rate risk as well that we take. Long-term debt could also be bonds, so treasuries and bonds that we invest in. What is the role in the portfolio? It gives a little stability to the portfolio, especially for those who are risk averse and want to have a little stability in the portfolio. It does give a little stability because it will not go up and down. It also gives interest income. So there is a small portion of interest which comes in. Equity, it's high return potential. We saw that most of the wealth gets created by equity, but it is volatile. It moves up and down. A 20% correction in the stock market can come anytime. It is normal and it should be expected. So you should, when you are investing in equity, you should expect the return asset class to be volatile. So there will be ups and downs because the markets are guided not just by logic, but also by behaviors, by emotions. So as an asset class, it is equity. It does not give, if equity has given 14% return in the last 10 years, it has not given 14% every year. Every year, the return has varied right from -20 to even, plus 50%. So the returns are not sequential. They go up and down. So that is there. And of course, there is market risk as well. The reason why we get high return is because there is a high risk as well. So there is a market risk involved. There is, especially with individual companies, there is always a risk that the company can go bust. Which is why I will cover a little later on, when you invest in equity, how do you invest? Whether you should invest in direct or professional, passive, active, India, global, listed, unlisted, GIFT City. I'm covering all of that in a separate slide because it's a little bit more complicated. So just bear with me on that. But remember that equity is where the wealth creation happens. It is where you can also get cash flow in terms of dividend. Or later during your retirement, when you don't have any other income, you can also take cash flow by selling equity to a systematic withdrawal plan. But the role of equity in the portfolio is really long-term wealth creation. And I'm covering a little bit more detail on equity in another slide. So just bear with me there. Gold. Gold, we spoke about it. It's a hedge against inflation, hedge against uncertainty. So in times of uncertainty, sometimes equity markets don't give good returns. They could also crash, which is what happened during COVID, right? Equity markets across the globe crashed by 50%. They picked up within a year, but at that time, gold is something which will either hold up or it will go up. So during uncertainty, gold is a good hedge to have in the portfolio. It is a store of value, but it also has price volatility. It is as equally volatile as equity. So even gold does not give the same amount of return every year. This year, last 2 years have been very good, but there have been years when gold has also not moved at all. So gold has price volatility as well. Another big drawback of gold is it does not really have any productive use. There is no income that you can generate with gold. Unlike equity, which can give you dividend income, debt gives you interest income, house gives you a rental income, gold does not really generate any income. It is just a store of value because people around the world for thousands and thousands of years have considered gold to be a product of value. That is where it derives its value from. Role in the portfolio is diversification and protection during crisis. And especially when you have a high equity in your portfolio, you should have some amount of gold as well to balance and give you a good diversification. Real estate, I think we all know it's a tangible asset. It will give you moderate to high returns. At the same time, it is illiquid and it does need maintenance. So if you have a house, you need to spend on maintenance as to maintain it once in a while. It does need regular maintenance. Sometimes you have tenants moving away and you sometimes lose money because of that. But that's fine. The advantage of this is it is a tangible asset. And it does give rental income. It does give capital appreciation. One of the questions that I was also asked in the survey was, how do we create different sources of income, or how do we plan for retirement? So I would say one very important way to plan for your retirement is to try to have multiple sources of income and have a very diverse portfolio where you have some part of your portfolio invested in each of these asset classes, so that you're diversifying your appreciation of capital, but you're also diversifying your income sources. So you're getting interest income, you're also getting maybe an annuity income, dividend income, SWP, you're getting rental income, and so on. That it kinds of takes care of different market cycles, because different assets behave differently in different market cycles. And across a long retirement of 20, 30 years, with multiple sources of income, a retirement can be much more comfortable. And why do I say multiple sources of income are important is also because most of these different asset class have low to negative correlation. That negative or low correlation means they don't move together, they move in different cycles. So in years in which gold is doing well, probably equity is not going to do well. In years in which equity is doing well, gold and real estate may not be doing well. When none of these are doing well, real estate is doing well. And when real estate is also not doing well, maybe debt is doing well. Yeah. So every asset class has its time in the sun. So a diversified portfolio helps you, kind of navigate through multiple years with decent returns and a strong portfolio. So if you just take one example, this is, by the way, chart from India. So the numbers might differ a little because these are INR returns. But I just wanted to use it as an example to show you how, winners keep rotating every year. And in the last 10 years, while, mid caps are basically the mid-size companies in India, small caps are small size companies in India. Last 10 years, mid cap have given 19% CAGR, which is annualized return is 19% in INR terms. That's quite high. But when you look at the return year on year, it varies a lot, right? Which is what is the volatility. 1 year it gives 12.6, then 6.8. Then there are 2 continuous years of negative or zero returns. So after growing 52% in a year, it drops by 12%. Next year also it stays the same. So for 2 years, it's just where it was. And then suddenly it gives 26% return, then 48%, then next year again. And then after that, it again stalls, then again good returns. So, equity moves in cycles. Unlike a bond, which probably gives you, or a bank account, which gives you 2% every year. So that's an important thing to know about equity. And many times people don't make a lot of money. Reason people don't make money in equity is because they don't stay through the cycles. They try to time the market and they enter at the wrong time and also exit at the wrong time, which is why most people don't make money in equity. But if you actually stay for a long cycle, you just stay invested, the compounded returns are actually the best in equity investments. Okay, there was a question on Dubai real estate as well. And because this real estate data is wrong because it is India real estate, I thought I will just show a slide on Dubai real estate. And this is actually from reported data by the Dubai government itself, where there is a property monitor dynamic price index. And this is how Dubai properties have moved over the last 15 years, starting 2010. This is an index which monitors the price per square feet across the city and so on. So the average price right now is 1681. But if you see, Dubai market has typically been in cycles, yeah. So the previous big cycle of 2012 to 2020, 8 years, from the bottom to the bottom was about 8 years, where the peak was at 172, then it again went to the bottom, and now for the last 5 years, it has just been rising. Of course, no one knows, no one can predict what will happen next. But this is where we currently stand. It is at all-time highs. And the history tells us that it's a cyclical market, but of course, no one can predict the future. Things can change. But many times history does repeat as well.
Rakhi, we did have a question on the previous slide. It was around how long to stay invested in the equity market. But I mean, given my experience, again, there's no clear-cut answer, but I would love to hear from you.
Yeah. I've covered that as well on time, on how long to stay invested in each asset class. So
Sure.
I will answer that question as well. Yeah. Okay. So now we looked at the 5 different asset classes. We also understood, that it's important. What is the role of each asset class in the portfolio? We also understood that it's important to have a little bit of everything to diversify your portfolio, to diversify your income sources, and also because every asset moves it, because winners keep rotating basically. So it's good to have a little bit of everything, like a balanced meal, right? Like how we have a balanced meal, we have a roti or a rice, then we have vegetables, we also have a char, papad, maybe curd. So we do have balanced meals. So that's why a balanced portfolio also makes a lot more sense. But how do we decide how much to invest in each? So there are 3 parameters that I have used. First is your risk appetite. Whether you're a conservative investor, moderate investor, or aggressive investor, that kind of determines what kind of volatility you can manage in your portfolio. Because if you have a very high concentration of volatile assets, then your portfolio is going to tend to be volatile, and how much volatility you can stomach depends from person to person. For example, during COVID, markets corrected by almost 50-60% across the globe. At that time, what would be your behavior? What would be your tendency as an investor? If you say that you would have panicked and sold all your investments because they have fallen by 50%, then you're definitely a conservative investor. If you would have held on, then maybe you can say you're a moderate risk appetite. But if you would have gone and bought more at that time because it's fallen so much, so it's available cheap. When something is available at a discount, you should buy more, right? If you have a discount in your favorite store, you're going to go and buy more. You're not going to sell, right? So that's what an aggressive investor would do. But also, so this risk appetite kind of, also helps you decide how much equity allocation you should have in your portfolio. There are a lot of risk metric tests that you can do online, but what I mentioned now is a very good test to have. Like, what would you do when you see your portfolio down by 50%? But also remember that, most of us, when we start on our investment journey, we start as conservative investors. And we can always, with knowledge, with experience, become more smarter and therefore aggressive investors. So it is also possible that risk appetite changes with more experience and with more knowledge. What is your time horizon of goals? This is really important. If you need the money back within a year, please don't put it in equity, because equities are volatile, right? It can correct anytime. And you don't want to be in a position where you need the money within a year, but the market is 20% down. So if you need the money immediately, keep it in low volatile assets, something which is safe, like an FD or a liquid fund, ultra short fund. If you need the money within 1 to 3 years, keep it again in something which is liquid, low volatile, but at the same time maybe slightly higher return. So short duration debt or arbitrage funds, so short-term bonds or some kind of arbitrage funds. But if you have the money that you don't need for 3 to 5 years, then start taking a little bit more risk. Put it in either gold or large cap equity. And 5+ years, put it in flexi cap, mid cap, small cap equity. Put it in international equity. So, US equity, India equity, whatever you consider as international, even global equity, real estate. There is also unlisted equity. So someone was talking about, can I invest in my friend's business, take a stake in a friend's business or stake in a startup? That is also equity. It's just that it's unlisted, which is it's not listed on any stock exchange, but even that is equity. But that needs a much longer time horizon. So depending on the time horizon, and this is really the most important thing here. If you want to take your money out within the next 3 years, then definitely don't invest in equity. Invest in equity or even gold or even real estate for that matter, only when you have a time horizon of greater than 5 years. Because that is where you will see the maximum returns. Third important thing, and this is where I think people tend to underestimate inflation. Yeah, is you need to see also what kind of returns you need to meet your goals, because we work for about 30 years, right? And then we have a 30-year retirement that we need to plan for. And I think at this age, none of us want to depend on our children for retirement. That means we need to fund our retirement from our savings and our investment portfolio, right? So at that time, then you need to also be clear. And we also have ambitions for our children. We want our children to get the best education, etc. So there are certain goals that most of us have. And there is certain money that you need to meet those goals. And to meet those goals, what is the return that your portfolio needs to earn? Yeah. If that return is going to be in the range of 7, 8, 9%, and then even if you're a conservative investor, then you don't have a choice but to invest in more riskier assets like equity, gold, real estate, because you need to do also a trade-off between your risk tolerance and also returns needed to meet goals. So it's also important for you to know what your goals are, how much money you need to meet those goals, and what is the return that your savings need to earn to meet those goals. And accordingly decide your asset allocation as well. So it's a fine balance between looking at your risk appetite, looking at, when do you need the money back, how much money do you need at what time frame, and also what kind of returns your portfolio needs to generate to meet all your goals. And this getting your asset allocation right, which is, kind of deciding how much money you have in each of the different buckets, is 80% of the job done. And my point here is we need to be a bit more intentional about our asset allocation. Sometimes we go bottom up, which is we just say, okay, this is a good investment. Let me invest in this. Let me invest in this. And asset allocation happens, just happens not by design, but by chance. That's not the right way to invest. The right way is to decide where you want to invest. So decide your asset allocation, what should be the balanced portfolio, and then decide which instrument to invest in each. So if you've decided you need to put, say, 1 million dirhams in equity, and then you go about choosing which fund that 1 million dirham needs to go in, rather than, choosing funds and then seeing, oh, this much I have in equity, this much I have in debt, and so on. Just a quick example of an asset allocation. Again, just for education purpose, asset allocation is actually very personal. It could differ largely from person to person. Even for the same person, it will be very different when that person is 20 versus 40 versus 60. But just an example to bring it to life is this kind of a portfolio where you have, say, about 10% in short-term debt and arbitrage. What does this do? This covers next 3 to 5 years expenses for this person. So like an emergency fund, college fund, because the kids are getting into college. So 10% of the portfolio covers the next 3 to 5 years of expenses. And this is kept in liquid instruments, which can be withdrawn anytime. Then there is some 5% in long-term debt, which is really ultra-safe investments, which serves as a cushion for doomsday and provides a stability in the portfolio. Then the rest of the 85% of the portfolio, which is not needed for the next 5 years, which can stay invested for the next 5 years, which is the 85% of the portfolio, is actually divided between the asset classes which beat inflation. So there is equity, which is India, there is global equity, there is gold, there is real estate, and each of these plays a role within the portfolio.
Rakhi, should we pause and take a few more questions?
Sure.
Anybody has any questions, feel free to just unmute and ask.
Okay, I think I'll just cover 1 or 2 slides where I'm answering a lot of the questions asked so far. Maybe
Sure.
that will help get more questions as well. Like I said, asset allocation is very personal. So it is for you, your family to decide. And it is something that should serve 2-3 purposes. It should maintain and grow your purchasing power. So it should make sure that you're creating wealth for the future for a long time to come. So therefore, you're beating inflation, you keep growing your purchasing power. It also gives you freedom of choice, because wealth does give you freedom of choice once you have wealth. At the same time, it also gives you peace of mind. So it is something that you're comfortable with, because there is no point in investing in certain assets, having a portfolio where you're checking your portfolio every day or every second or every week. There is no point in having that kind of an investment portfolio which doesn't give you peace of mind. Therefore, it is important to have those emergency funds. It is important to have those investments in liquid funds, short-term debt, having some kind of stability in the portfolio, because only then it will give you peace of mind to not be bothered about checking your portfolio very often. So basically, beat inflation, grow your purchasing power, therefore give you freedom, and also give you peace of mind. Can I ask a question? Like, how many of you know what your asset allocation is? How many of you can today now in 10 minutes make this kind of a chart for yourself, for your family? I can see a few thumbs up. Nice. Cool. So I can see that there are a few people who can make
Sorry,
the chart.
Rakhi, I do have one question in terms of asset allocation. I have a fair understanding of this, but my question is, do you take the market values or how much you've invested in?
Always market value.
Okay, got it.
Always market value. Okay. So I'll cover the next one, which we spoke about, which is how to invest in equity. So equity is a fairly complex asset class. So there are different decision points to be made on how do we invest. One question is, should we invest directly or should we go through professional management? So direct equity is basically you decide what shares to invest, and then you invest directly in those companies. Like you decide, I want to buy Apple, Microsoft, Amazon. I don't want to buy Meta, Tesla. Therefore, you buy these three stocks. You hold them for some time, maybe sell after 6 months, again buy something else. So that is an active management where you're doing your own direct equity portfolio. You can do this, but you need to understand that it requires certain skills. First of all, it needs time to research, monitor, and rebalance. In US, there are more than 5,000 listed securities. In India, there are more than, again, 5,000 odd listed securities. So do you have time to even research 10% of these companies? To regularly keep monitoring, look at their quarterly reports, look at the news that is coming in, talk to people on the ground about these companies. Do you have that kind of time to research these companies, sectors, etc., and then monitor and keep buying and selling? Do you have the interest to actually go through balance sheets, profit and loss statements, cash statements, etc.? And do you have the skill to do that as well? If you have all these three, then you're as good as a fund manager. I mean, manage your portfolio directly. But if you don't have, then don't try it, because it's not easy, right? It's not as easy as it sounds. It's just take a tip from someone and buy a stock, or take a tip from someone and sell a stock, or just buy based on past performance. It's not as simple as that. There are a lot of fund managers who try to actively manage equity, and even qualified fund managers do. Not all qualified fund managers do well. Therefore, unless you have the time, interest, and skill, it is better to invest through funds, through professionally managed funds. And we can choose the right funds based on a few criteria. Like you can look at risk-adjusted returns. You can look at how good the fund is. So what kind of returns the fund is giving, how well they are managing their risk, how well they're managing their volatility, and what kind of skill the fund manager is bringing. I'm covering this as well in the next slide with an example. So move on. The other way to invest in equity is also whether you invest passive or active. So whether you invest in a benchmark like a Nifty 50, Nifty 500, S&P 500, Nasdaq 100. This is called passive investment. So should you just invest in a benchmark index, or should you go for actively managed funds? So the data shows that passive funds work best for mature markets, like large caps in India and the US markets. But when you go for mid cap and small cap markets in India, it's not such a mature market. So actively managed funds do much better. India versus global. So someone talked about GIFT City. So the best way right now to invest in Indian mutual funds or India equity is via GIFT City, because the gains are tax-free. Typically, if you would directly invest in a mutual fund in India, you would pay long-term capital gains of 12.5% or short-term capital gains of 20%. But if you invest via GIFT City, it is tax-free. That is, you don't pay any tax in India. And because we are lucky, we are in Dubai, we are in UAE, we don't pay any tax in UAE as well. So it is great tax-free income that you can earn from Indian equity if you invest via GIFT City. The NAV, the asset value of the fund is declared in dollars, but remember that finally the money is getting invested in India only. So the money is getting invested in INR. So you are definitely taking a currency risk. So the risk, you are converting, the money is finally getting converted into INR. So the currency risk is always there. So the return that you will get is after currency depreciation, and Indian currency typically depreciates 4-5% every year. But India grows much more than that. Therefore, the returns that you earn is much higher than the depreciation, and therefore net return will be in dollar terms will be lower than the INR returns. So the currency risk is there, but you save on taxes. So GIFT City is definitely a best way to invest in Indian mutual funds right now. There was also a question in the survey on how to invest in US. How do I start off on US investing? So there are many ways. There are a lot of platforms. There are a lot of platforms like Interactive Brokers is the biggest. There is Sarva. So there are a lot of platforms. There is GIFT City as well, which has US investment funds. But the thing is, when you invest in these platforms, just make sure you're not investing directly in the US. So you're not buying a share in the US, or you're not even buying an ETF in the US. Rather, you're buying ETFs which are listed in UCITS. So these are ETFs listed in Europe, like Ireland, etc. Or it is all through GIFT City. Why? Because to avoid inheritance taxes. Because what happens is in the US, if you're not a resident of the US and you invest in any asset in the US for more than $60,000, you are subjected to inheritance tax, which means if the investment is in your name and you were to pass away, there is a 40%, minimum 40% tax that your family will have to pay before they get the balance. The family will only get 60% back. 40% will go in taxes. So to avoid these taxes, it is better not to invest directly in the US, but rather to take exposure in US via an international financial center, which can be in Europe or GIFT City. And there is a lot of material available in the internet as well on this. The last point.
So Rakhi, if you invest in US shares, but through a platform which is based in like a European one, then it's not subject to inheritance tax?
No, if you invest directly in US shares, you are investing in US markets directly. So if you buy an Apple share or an Amazon share,
Right.
then you will be subjected to inheritance tax.
It will be. Okay.
It will be. It is when you invest in US market through ETFs, which are domiciled in European countries like Ireland, etc., which is basically called UCITS. UCITS is nothing but European mutual funds. Mutual funds in Europe or ETFs in Europe are called UCITS.
Okay.
So
Thanks.
there are actually a lot of people who get, sorry, I'll just finish this. There are a lot of people who get ESOPs in companies in the US like Amazon, Google, Microsoft, etc. Even these ESOPs are actually subject to inheritance tax. Sorry.
Sorry, Rakhi, just a question in terms of inheritance tax. But there is no capital gain tax in the US for non-residents, right?
There is no capital.
Okay.
Yeah. But there is withholding tax on dividends. So if you take with dividends, there is almost, I think, a 20 or 30% withholding tax on dividends, but no capital gains tax.
Okay.
Okay. The other is on listed versus unlisted. I hope everyone understands listed. Listed is basically when the company is listed on a stock exchange, like most of the big companies are listed on the stock exchange, whether it is Unilever, Nestle, Amazon, Google, etc. Yeah. So these are publicly traded companies. You can go and buy them on any exchange, whether it is NASDAQ, S&P 500, or for India, there is NSE, BSE. Yeah. So these are listed on some exchange, which means that you can go and buy these shares are being actively traded through the exchange. And also these, because they are listed publicly, the public is going to invest in them. They have to follow a lot of regulation. In India, it is set by SEBI, Companies Act, etc. In the US, there is the SOX regulations, etc., that these companies have to comply with. So there are a lot of guardrails to protect the minority investor. Once a company becomes public, the government itself puts a lot of guardrails to protect the minority investors in terms of regular reporting, in terms of regular audits, and so on. But what happens when you invest in the unlisted space, whether it is a pre-IPO or a startup, early stage, venture capital, private equity, whatever it is, these are unregulated spaces. So these are That's why, because they are unregulated, they are high risk and they are also low liquidity. Low liquidity because they are not traded on an exchange. Today, if you have shares of Amazon or HDFC Bank, you can go and sell them tomorrow on an exchange and they will sell. But unlisted shares, there is no, you need to find a third party who is willing to buy the shares. And then you need to negotiate a off market deal, right? So the price is not transparent. There's no mechanism to sell it. So these are therefore, liquidity is also low. There is a potential for higher returns because there are a lot of sectors that unlisted spaces are looking at where listed space takes time. So for example, this whole AI boom, right? There is a lot happening in the unlisted space with smaller companies, whereas in the listed space, it takes time for a lot of companies to get into AI. So there is a potential for higher returns, but the risks are very significant as well. So if any of you are investing in unlisted space, I will only say do that only after you have a very solid portfolio of listed equity. So most of your portfolio and equity should be in listed equity. Only after you have a solid listed equity portfolio, you have some money, you are passionate about some sectors, then go for unlisted spaces. But again, try to choose platforms, do a proper due diligence on what kind of platforms you're investing with. They should have a strong selection process. They should be actively involved with the founders to make sure that, the founders are doing what they promise to do, because you don't want to be in a position where founders come, pitch something, take money, run away, right? So there has to be some monitoring of the founders. There has to be a clear exit strategy. And even after all of this, if you want to invest in startups, make sure you're able to invest at least across 10 plus startups so that you have some diversification, because the fail rate is very high. 60 to 70% of startups, sometimes even more, will fail. And maybe one of them, if you're lucky, will, give you really good returns to make up for all of the losses. Therefore, unless you're able to diversify across multiple startups, it really does not make a lot of sense to get into the space. Personally, I have invested in about 13, 14 startups through a platform, which I'm happy with. But at the same time, it's a very, very small part of my portfolio. It's in fact money that I'm comfortable to write off. Like even if I were to write off this money, none of my important goals will get impacted. So that is the way you need to, I think, look at unlisted space. Unless, of course, you're investing in your own business and you have full control on that business, then it's different. Overall, I think what I have seen has worked really well, as even for me and a lot of my clients and friends, is choosing good fund managers and staying invested over market cycles. So not trying to time the market, rather staying invested in the market with good fund managers, with good funds, whether they are mutual funds in India or they are good ETFs in the US, or good global funds. Just selecting the good right fund managers and also staying invested over market cycles without trying to time the market too much. So staying invested for 10, 15, 20 years, this is what will give you the best returns. And why am I saying that you need to choose, be careful about choosing good fund managers is just an example I have here. So this is a bit of a complicated slide, but without getting too, bogged down by the numbers, I'll just try to explain. This is basically a list of flexi-cap funds, flexi-cap mutual funds in India. I have sorted them based on median returns. So this particular fund has given the highest median return. This fund has given the lowest median returns. Yeah. Now, if you look at the range of returns, and this is 3-year CAGR, 3-year rolling returns, the range of return in a similar category of mutual fund, which invests in similar companies over the same time frame, ranges from -1%, yeah, to 52%. So timing is also a matter. So depending on the timing you get in, and depending on which fund you choose, your return could range from -1% over 3 years or 52%. So if you had put in, say, 100 rupees at -1%, that would have become 97 rupees. At 52% over 3 years, 52, 52, 52, it would have become about 350 rupees. Yeah, so the range can be quite wide. So it makes sense to look at the past returns of the fund manager, look at who the fund manager is, what kind of style he or she has, how do they choose the best fund, how are they managing volatility. So look at this particular fund here. The median return it has given us 22, maximum is 36, but the minimum is also 14%, and 14% is very good returns. So at any point of time, if you would have just invested in this fund, at the minimum, you would have made 14% over 3 years. So, not only maximum returns, but also average returns matters. And how well the fund is able to beat the benchmark also matters. So the benchmark return in this case is about, 23 odd percent. So most of the funds on a median basis, median returns is about, I think, 14%. So most of the funds have bet the benchmark, but some have betted by much bigger margin. But there are some funds which have not bet the benchmark as well. So some kind of a due diligence is needed on, before you select which fund to invest in. Okay. Sorry, that was a long thing. I think I'll pause for any questions and also any other question. And one question from my side. We spoke about 5 asset classes, but is there any other asset class that you can think of?
I was thinking crypto, Rakhi, but I don't know where it fits.
Yeah, crypto is definitely another asset class. And I got 2-3 questions about crypto as well. So I have a slide on that.
Rakhi, what about art? Art as an investment?
Sorry, art, yes, definitely. Art is another asset class, yeah. Yeah, so I think art, crypto. So because some people asked about cryptos, I've just made a slide on it. I don't know if I have time, Manali, maybe I'll skip this. But just one thing I want to say about crypto, I'll not go into a lot of details, but basically like unlisted equity, I mean, it should be a very optional part of your portfolio because it has much higher risk than the potential for return. It is extremely volatile. It has no intrinsic value. It does not give any cash flow. There have been so many scams and frauds on crypto. Like I think FTX, many of you would be familiar with because the founder was based here. Yeah, the entire exchange collapsed. There have been so many Ponzi schemes. It is not regulated again. Most of the governments across the world don't recognize cryptos. There are a lot of security risks involved. I mean, why get into it before you build a more stable portfolio? If you want to, when you're building a portfolio, this should be the last thing you should be looking at. You should first look at building all other 5 asset classes that we spoke about. If you still have extra cash, maybe, 0.1%, 0.2%, 1% at the maximum, you can put into this and see. But personally, I've not invested a single rupee also in crypto. I don't believe in that asset class. For some reason, I'm not able to.
Hi, one question. How about investing in Flipco, that building blocks? We are just investing in the real estate, but as a part of larger group.
That's very new, to be honest. If you want to take a portfolio, an allocation to real estate in Dubai, you don't have a lot of money to put in. Maybe a little bit. I don't know. It's very new to say. Any asset class, you should give it at least 2-3 years to get some kind of data on how the asset class is performing, how things are getting regulated, how it is getting monitored. I mean, see, because it's your money, right? You don't want to experiment. It's okay if you're experimenting with a small part of your portfolio, but it cannot be a serious play in your portfolio. That actually is a good segue to, what not to invest in. There are a lot of investments which combine insurance plus investment, especially in India. There are a lot of endowment funds, there are ULIPs, etc. I think there are some Zurich plans, etc. here as well, which try to combine insurance plus investment. The problem with these kind of instruments is they have very high charges. Upfront, ongoing, they have long-term lock-ins, and it is mostly in debt instruments, so it is giving very low return. At least if an instrument is giving low return, it should give you high liquidity. If an asset class is giving you low return and also low liquidity, stay away from it. Because for low returns, you should at least get high liquidity. And whatever you invest in has to be efficient from a tax perspective, efficient from an expense perspective. Every investment will have some charges like fund management expenses, etc. But it needs to be efficient. So if you want to invest in debt, I mean, just put it in the bank rather than invest in this kind of product, which takes very high charges and also does not give you liquidity. But you also need to manage risk. So we spoke in the beginning that you need to manage your risks and expenses. So what kind of risks? So you need, risks that, the earning member of the family, something could happen to that person and there are dependents without a source of income. So therefore life insurance is required. So you can take a term life insurance, which is the cheapest way to go for life insurance. Of course, medical insurance is a no-brainer. I think in Dubai, especially, all of us have at all times medical insurance. Critical illness and disability, as needed, depending on your need, depending on your thinking, you can go for it, you can even not go for it. But term life insurance and medical insurance are absolute necessities to have. What you should also not do is, and I covered this, invest in equity for short term. So day trading, buying with leverage, futures and options. There was actually a study done by SEBI where it found out that more than 94% of people who do day trading or invest in futures and options are actually losing money. So it is only the 5-6 people who are actually investing with a lot of tech, the big sharks who are actually making money out in F&O. Everybody else is just the retail investors are definitely losing money by day trading in futures and options. And investing in direct equity based on tips, it is much better to just invest in mutual funds, managed funds, and forget about it. When you invest with low conviction, what typically happens is you end up selling in panic. And to avoid all of this, best would be to avoid equity for long term, invest in equity only for avoid equity for short term, invest only for the long term, 5+ years. And invest directly only if you have time plus interest plus skills. Otherwise, just go the mutual fund or the ETF route. What is also important is to not chase the latest winners or chase very high returns. It is better to have an asset allocation and stick to your plan. FOMO, which is fear of missing out, leads to a lot of impulsive decisions. So this actually happened, I think with silver. I don't know how many of you follow silver, but 1 month back, silver was like going up like crazy, right? It went up 20-30% in a month. And then a lot of people thought, oh, now we should invest in silver. Silver is running. We need to get hold of silver, etc. But actually, this actually leads to wrong decisions, because think about it. If something has already done very well, has given 60% plus returns in 1 year, what is the chance that it is going to continue to give 60% plus returns? But our mind thinks differently, and these are some of the biases in investing that we should be aware of. That our mind thinks that if something has grown 60% this year, it is going to keep growing 60% more even next year. But that's not how it happens, because we just learned that winners keep rotating. So something that is actually not doing well today is most likely the one which is going to do well tomorrow. And even something like, Bitcoin. Bitcoin has, I think, given FOMO to a lot of people. Even people who don't understand Bitcoin, don't understand blockchain, want to invest in it because it has done well in the past few years for whatever reason. But as an asset class, it remains very risky, right? It does not have any intrinsic value. So it is, I think, best to avoid FOMO, to rather focus on keeping your capital safe. Because if you lose capital that's minus 100%, then, it's going to take a lot more money to just get back to 0.0 again. So it is better to, give up some high return options, rather protect your capital and look at your total portfolio returns. CAGR is compounded annual growth rate. So focus on earning a total portfolio growth rate rather than individual asset returns, rather than thinking about individual assets. So asset allocation, asset allocation, asset allocation, and aim for a very reasonable return over a very long period of time. And why do I say that? Because of power of compounding. Power of compounding works only after 8-10 years of staying invested. So someone asked, how long should we stay invested in equity? Stay invested as long as you don't need the money back. I mean, don't take out the money just because someone is saying that there is a bubble in the market. Someone is saying that markets have gone really high, or someone is saying that there is a war that is going to break out, or there is tariffs which has come, or, Trump has come, so we should sell. No, just stay invested. And withdraw the money when you need the money. Because there was a study done by HDFC Fund House where they looked at last 30 years of returns of their flagship fund, which was again the HDFC Flexi Cap Fund. So if an investor missed the best 30 days in the fund, their return came down from 19% to 15%. So 4 percentage points dropped over, 30 years just by missing 30 days and 30 years. Because that's how equity moves. When they move really quick, and it is not so easy to catch things when they start moving that fast, whether up or down. So the best way is to kind of accept that you cannot time the market. Rather, it is better to stay invested and aim for a reasonably high return, which is 12%, 15% CAGR. Because even that can grow your wealth significantly. Once power of compounding starts kicking in, money starts working for you. So the first 10 years you work for money, 10, 15 years, then money starts working for you. It becomes like a hockey stick, right? So even with a 12% XIRR over 25 years, if you had invested 15,000 dirham per month, at the end of 25 years, you will invest about 4.5 million dirham. But the money will grow to, at 12%, 27 million, at 15%, 44 million. So at 15%, like you can imagine, you've invested only 4.5, but your portfolio is worth 45, yeah, or 44.5, whatever. So your profit is 10 times of what you have put in. So that's the magic of power of compounding. That's the magic of, staying invested, which is why people always say markets reward the patient, markets reward the disciplined. I don't know, Manali, how much time do I have?
About 10 minutes, Rakhi, but I think we need to spend some time taking questions. So maybe 5-7 minutes for the next couple of slides.
Sure. So this is basically a repeat of everything that we discussed. So I'll not talk about this. I'll rather share this. So if you remember nothing else, just, maybe take a print of this and put it on your wall. So this will kind of be a guide for you to get started and stay invested. I'll now just cover an important topic, which is estate planning. Estate planning is basically, it's not only about we making our wealth, we earning our wealth, we saving, but it's also about how well we are able to pass on our wealth to the next generation, right? So that is why estate planning is important, because it ensures a smooth wealth transfer. It also minimizes disputes. It optimizes for taxes as well, where relevant. So a couple of examples I'll give when I think of estate planning. One person that comes to my mind is Dhirubhai Ambani. So he was one of the smartest person, right? Smartest in the world, such a big empire. He grew from nothing. But when it comes to, estate planning, he failed. He died without a will, and, it led to one of the biggest disputes in the history of business. And, I think the relationships are still sore. So, some kind of succession planning, if he was able to do that, would have really helped. So it is really important to have some kind of a succession planning, have those conversations in the family to minimize disputes later. The other example I can think of is one of my uncles. He passed away at very suddenly at a fairly young age. He was about 46, 47 when he passed away. But his family knew nothing about the financial situation. And I think this is true for many women, educated, not educated, it doesn't matter. Many women just delegate their money situation. They are not aware of what is happening from a financial perspective. They are not aware of basic things like, what are the bank accounts we have? What are the, assets we have? Who are our financial advisor? Whom to reach out for help, and so on. So when the family doesn't know what kind of assets have been built, what kind of transactions exist, what kind of liabilities are there, then it becomes very difficult to manage things, because if you don't know what can you manage, right? So it's better not to get into that kind of situation, which is why I just have 2-3 points here. It's important to prepare ahead. So, just have a simple Excel sheet or, simple document of what my family needs to know, where you have details of all assets and liabilities. You don't have to put the amounts, but at least capture all your bank details, capture all your portfolio accounts, capture where the money of the family is spread, capture who the financial advisors are, who the RMs are, where are the documents of real estate, etc. stored, what are the locker details, all of these things, have them in one place, and make sure you have those conversations so the important family members know about this and can access this as much as possible. Simplify as much as possible. Of course, goes without saying, no point in having multiple accounts. have nominations for all financial assets, and of course, adequate life insurance, especially if there is a single earning member and there are liabilities, whether it is a home loan which is uninsured, or there are any inheritance taxes to be factored for. Just make sure there is adequate life insurance as well, so there is ready cash for the family to take care of these things. There are a number of asset transfer tools. This estate planning is by itself a 1 hour session. So I cannot cover this in a lot of detail, but just remember it is important to have wills, at least wills as a basic thing within our family. Also, because we stay in a place like Dubai, I'm not sure how many of you know, but if a male member of the family were to pass away, the spouse is sometimes, depending on who all are there in the family, is not the person who's going to inherit and everything if someone dies without a will and Sharia law was to come into play, right? They may get as less as just 12.5% of the estate, because there is a certain portion which goes to the son, daughter, parents, and so on. So it is important that you decide what you want to do with your assets, when you're not there, and kind of prepare for it. So that's very brief on estate planning. Okay, so I think Manali, I think that's it.